In late 2010, the Irish government would agree to an €85 billion bailout programme with participation from the Irish state, the IMF, the European Union and the nations of the UK, Denmark and Sweden. In the wake of the Irish banking crisis, the economy was in ruin. The Irish government had spent over €64 billion saving its banking system. There was a transfer of wealth from Irish taxpayers to the creditors of Irish banks. Public debt was soaring, economic activity was declining and unemployment was on the rise. Ireland was seen as a risky investment in the international debt markets, and as a result, the country's cost of borrowing skyrocketed. It was under these circumstances that the request for financial assistance was made. However, when we look at the key decisions made in the months and years leading up to the bailout, a controversy emerges. Could the Irish government's response to the banking crisis have been better? And more importantly, could there have been a lower financial cost to the Irish state? It all starts with the guarantee. Following the collapse of Lehman Brothers in the US on September 15, 2008, Irish banks fell under immense funding pressure. There was fear in the market that Irish banks could default on their obligations, and as a result, a run on the banks ensued. On September 30th, 2008, the Irish government made a huge decision to provide a 2-year guarantee covering nearly all liabilities of Irish banks on an unconditional and irrevocable basis. The value of the guarantee, €375 billion, more than twice Ireland's gross domestic product at the time. This guarantee had the effect of joining both Irish public finances and the Irish banking sector at the hip. If the banks went down, so too would the Irish sovereign. Naturally, there were criticisms of the guarantee. Many argued that it was far too broad and provided excessive coverage of bank liabilities. Others noted that having a 2-year duration would simply result in a resumption of panic when the guarantee period ended. But perhaps the greatest criticism was the fact that the Irish government made this decision without considering the consequences for the rest of Europe. Other European governments were now expected to follow suit with their own guarantees. There was a fear that European banks would lose funding as a result of individuals and institutions transferring their money to Irish banks where there was a government guarantee. Ireland's decision is one of the main reasons why a harmonised deposit guarantee scheme exists across the EU today. However, unbeknownst to the Irish government, the guarantee had been provided on the basis of incomplete and inaccurate information. The general consensus within the government was that the banks were experiencing a liquidity problem. In other words, the belief was that the banks had enough assets to cover their liabilities and that the problem was that those assets were simply illiquid. Therefore, all the banks needed, in theory, was temporary access to cash now in order to meet their short-term obligations as well as relief from the bank run. This belief in there being a liquidity problem was reinforced by the fact that, according to financial statements, all 6 of the Irish domestic banks at the time the guarantee was given were compliant with their minimum financial requirements. This was good enough evidence for the government to provide a guarantee for the majority of their liabilities. The reality, however, was much more sincere. This wasn't a liquidity problem, it was a solvency problem. The bank's assets, which were heavily weighted towards property-related loans, were overstated by billions of euros. If the true value of the bank's assets were reflected in the financial statements in 2008, the government would likely not have provided the same guarantee. The reason why bank assets were overstated was because the accounting standards at the time did not require expected credit losses to be recognized in the financial statements, thus leading to a dramatic overstatement of the bank's solvency. So, in effect, the government had put Ireland's public finances on the hook for billions of euros worth of banking losses by issuing the guarantee. When the true scale of the losses started to become apparent throughout 2009 and 2010, there was a real fear that the guarantee could cripple the creditworthiness of Ireland as a whole and its ability to borrow money. In the government's defence, providing a blanket guarantee for bank deposits and liabilities was and continues to be an established response mechanism for dealing with crises. In fact, that's what the Swedish government had done in the 1990s for their banking crisis. Much of the solutions that were deployed by the Irish government post-2008 were done with the Swedish playbook in mind. Ray Dalio, in his book Big Debt Crises, noted that guarantees are one of the 4 steps that policymakers can take to ensure the survival of systemically important financial institutions. Plus, the consensus among policymakers globally was that in the wake of Lehman Brothers, banks should be prevented from failing. Therefore, therefore it wasn't necessarily the action of providing a guarantee that was controversial, rather it was the lackluster data on which basis the guarantee was made. The misdiagnosis of a liquidity crisis in place of a solvency crisis was a big error by the Irish government. As Dalio notes, the biggest risks are not from debts themselves, but from the failure of policymakers to do the right things, due to a lack of knowledge and or a lack of authority. Because of the belief that this was a liquidity crisis, the Central Bank of Ireland agreed to provide Irish banks with billions of euros worth of exceptional liquidity assistance, or ELA loans, to shore up their liquidity position. However, had the true financial position of certain Irish banks been known at the time, the ELA loans would likely have been in direct contravention to the European Treaty, which prohibits monetary financing of insolvent institutions, specifically in the case of Anglo-Irish Bank. Now, that said, even if the Irish government were knowledgeable about the true solvency position of Anglo, liquidity support and some form of guarantee would likely still have been provided. Why? Because Anglo was a systemically important bank in the Irish context. If Anglo was allowed to fail, then huge funding pressure would undoubtedly have spread to other Irish banks via contagion, threatening the entire Irish banking system. If all of the Irish banks were to run out of money due to a bank run, you're looking at a catastrophic, immediate and sustained economic-wide disruption that wouldn't be allowed to happen. My guess will be that the financial support that Ireland received in late 2010 would have been received 2 years prior in one form or another, had the true financial position of the banks been known at the time that ELA was provided. But perhaps the biggest ordeal was figuring out how much recapitalization was needed in order for the banks to survive. Policymakers truly had no idea of the exact financial position of Irish banks at the time, especially in the ever-evolving situation of the Irish property market crash. This made it very difficult to ascertain the true cost of saving the banks. Throughout 08, 09 and 2010, the exact amount of support that the banks needed from the state constantly changed. Each year, billions of additional support was provided to bridge unforeseen gaps in the bank's capital positions. Part of this uncertainty was due to the role played by NAMA, or the National Asset Management Agency. NAMA is a state agency that was established to take the bad loans off of the bank's balance sheets in order for them to be managed externally and for their value to the state to be maximized. Getting these loans out of the banks was important because they were driving up the amount of capital that the banks needed to have on hand. However, part of this process required NAMA to provide the banks with compensation in the form of NAMA bonds for the loans acquired. Establishing a fair value for the loans acquired was both a challenging and delicate exercise. If NAMA paid too little for the loans, then the banks would require further capital support from the Irish state. If they paid too much, then NAMA's profitability and business objectives will be impacted. In total, NAMA acquired €74.2 billion worth of loans from the banks for €31.8 billion, an average haircut of 57% over face value. These haircuts represented real losses to the banks and impacted their capital positions, which in turn increased the amount of government support that was necessary over time. However, it's expected that by 2025, NAMA will return a net surplus of €4 billion to the Irish Exchequer, having generated €45 billion worth of cash from its loan management process, as well as 11,000 residential units and over 2,600 social homes. When Ireland requested financial assistance in late 2010, a financial measures program was conducted to determine the true financial position of Irish banks once and for all. This exercise did not include Anglo-Irish Bank or INBS, as these banks were not a going concern. The Irish government had already invested €34.7 billion in these banks by the end of 2010, the vast majority of which will never be recovered. When the program was concluded in early 2011, an additional €24 billion worth of recapitalization needs were identified across AIB, EBS, Bank of Ireland and Irish Life and Permanent. In total, the Irish government invested €29.4 billion in these banks, and as of June 2023, €2 billion has yet to be recovered. There's a common misunderstanding that Ireland's €85 billion bailout package was used to rescue the banks, but this isn't the case. Firstly, the true figure for external support is actually €67.5 billion, considering that €17.5 billion came from a combination of Ireland's National Pensions Reserve Fund and Exchequer cash. Before the external support, Ireland had invested €46.3 billion in the Irish banks. Of this, €34.7 billion came at no initial cost to the state due to the use of promissory notes for Anglo-Irish Bank and INBS. These notes were pledged as collateral to the Irish Central Bank for the purposes of raising ELA. Eventually, when these banks were liquidated, the promissory notes would be removed and replaced with a portfolio of Irish sovereign bonds and NAMA bonds. This had the effect of spreading the liability of Anglo and INBS over 40 years. After the external support, the €24 billion worth of additional capital that was identified as part of the Financial Measures Programme was funded via the National Pensions Reserve Fund and Exchequer cash. What's rarely mentioned is that the Irish banks were able to reduce the burden on the state by over €15 billion through the use of liability management exercises, which effectively involve repurchasing subordinated debt for less than par value, thus pocketing the difference as profit. So in actual fact, the Irish government used none of the external support for recapitalising the banks. Rather, the support was used for Ireland's budgetary deficits, which were arising due to the fact that the Irish government had placed far too much reliance on property-related tax revenues throughout the boom. With those revenues now collapsing, in addition to all of the other negative economic circumstances that were prevailing, plus the fact that Ireland's cost of borrowing had skyrocketed, external support was essential to keep the country running. So the real controversy is not what happened when everything started to fall apart. It was what was happening up until that point. Yes, you could argue that the government should have identified the solvency crisis much earlier and before the guarantee was put in place. But the lack of reliable information was a byproduct of the culture that had been cultivated over the previous 10 plus years. There's no doubt that the cost of saving the banks from 08 could have been lower with an optimal response. Unfortunately, the system just wasn't set up for that kind of response. Plus, there's no getting away from the fact that by 2008, the damage was already done, and there was no getting away from a multi-billion euro bailout from the state. Responsibility for the crisis, and thus the controversy surrounding it, will always lie with the government, regulators, the banks, and all of the middlemen and stakeholders who profited from Ireland's property market boom. If you want to learn more about the crisis, check out either of the videos popping up on screen now.